Hello all and welcome to Perked Investing. Today we are going to look at the quarter 3 results of Nestle. So if we look at the revenue, we can see its revenue has been increasing quarter on quarter as well as year on year. We can see its revenue is increasing. Now if we look at the total revenue growth over the past 6 quarters, we can see it has shown a very inconsistent growth. It has shown a negative growth as well in 2 quarters, but this is the best quarter they have seen with respect to total revenue growth compared to the last 6 quarters. Now if we look at the same thing in EBITDA growth rate and PAT growth rate, we can see it is following the same inconsistent pattern. It has fallen 3 times in the negatives, and here is the same 3 times negative growth, but this time they have bounced back to up to 24% and here nearly 30%. But if you look here in revenue, they had their best quarter in the past 6 quarters, and here they are only having their second best quarter. So their revenue growth rate is increasing, but when it comes to EBITDA and PAT, they are not being able to translate the same here. They are showing the second best quarter. Now if we look at the operating profit margin and net profit margin, we can see they have been falling, but it has been same with the every other Nifty 50 constituent. Their profit margins have been falling, and this is not a very good outlook. And they have not been able to comes to the term as of that last year. Their operating margin has increased in this year, but when it comes to September 21 quarter and September 22 quarter, it was at 25% and currently it has 22.3%. So there is a huge gap up here, and they can bounce back. And similarly the same pattern follows in the net profit margin. The profit margin has increased when it compares to the last 1 year, last quarters, but when it comes to the last quarter, last year's same quarter, the growth rate was at 15.76%, and now it is at 14.46%. So also there is a gap of nearly 1%, and they can improve the margins here as well. Now if we look at the results at the snapshot, we can see increasing total revenue increased by nearly 18% year on year. EBITDA margin increased, EBITDA increased year on year by 6%, and net profit has increased by 8.26% year on year. If we are talking about EBITDA margin, has stayed in line with last 4 quarters at an average of 22% only. The margin is at 22% only, as we have seen previously. It hasn't been able to cover up. And if we are talking about the NPM margin has increased from 13.4% to 14.46% in the last 4 quarters. Now, if we want to check at the fundamentals at the glance, its market cap is at 1 lakh crore and enterprise value is near at 2 lakh crore nearly, and enterprise value is far or less nearly the same. ROE is at 104%, which is good, which is great. ROC is at 55%. Return on capital employed. EPS is at 224 rupees, while the share price is at mid 20,000 or 20,000. PE ratio at 90%, while the industry PE is only at 20. So there it is highly overvalued compared to its peers. PB ratio at nearly 90 to 100%. It is ranging, so this is also not good. The PB ratio of the industry ranges from 30 to 50 at max, but here it is nearly 100%. Debt to equity ratio 0.12%, which is a huge positive here. That has slightly increased in the past year, but it is still good. Now if we want to look at the shareholding pattern, we can see pledged and unpledged promoter holding more and less has been the same. It is exactly the same from the last 1 year, and none of the promoters has pledged their holdings. And if we want to look at the mutual funds, we can see there has been sellings at 1 and 2 instances. Now the insurance firms and others make up the total domestic institutions, and we can see domestic institutions has sold some of their holdings in 1 and 2 instances. But if we want to look at the overall shareholding, we can see it was at 4%, and now it nearly is at 5.13%. So in the long run, the domestic institutions has increased their shareholding. Foreign institutional holdings, we can see, is decreasing in every other Nifty 50 constituent. So there is no huge surprise here. It is falling. It is supposed to be falling, so it has fallen. And retail and others, this is a kind of a little surprise, because retail is also selling their holding. So retail and FII is selling, but DI is buying. So there is a unusual pattern here. Usually DI and FI sell and retail buy, so there is that. And now we want to look at the top 6 mutual fund holdings. As we have seen, mutual funds are selling. So in the last 3 months of nearly all the mutual fund except UTI MNC Fund Growth Direct Plan, all mutual funds have sold some portfolio weight in the last 3 months. And these are all, if you want to look, these are all long term funds, blue chip long term and flexi cap funds. So if you want to invest in Nestle, you can invest in Nestle through these funds. They kind of hold the maximum of Nestle as compared to their portfolio weight and as the market share of Nestle. Axis hold the most market share of Nestle in terms of mutual funds, and then Axis blue chip fund UTI. So 1, 2, 3, 4, 5, 6. They are arranged in the number of market share that they hold of Nestle. Now, if we want to look at the price movement, it has made a high of 20,350 while the low of 16,000, giving us a return of 6.7%, which is a great return. Now, if we look at the low range and we can check in the low, it was 16,000, but current price is at 20,294, I believe. So this is nearly not it is almost exactly it has 52-week high. And if we want to compare its price comparison with Nestle, Nifty 50, Sensex and Nifty FMCG, we can see Nestle has given 6.7% return, while Nifty 50 and Sensex has fallen by -3 and 2.78, and Nifty FMCG has given the double return of Nestle as 13% from 6.7%. So if someone would have invested in Nifty FMCG ETF and mutual fund, they would have been able to generate better returns than only investing in Nestle. Similarly, that's what I told in the previous part, that you can invest in Nifty in mutual fund that were holding Nestle, that would have been able to generate better returns as compared to only holding Nestle in your portfolio. If we want to look at the peer comparison, we have compared it with Britannia and Hindustan Unilever. Hindustan Unilever has given nearly 11% return, Nestle has given 8% return, and Britannia has given 13% return, and Nifty FMCG has given 13% returns. So here you can say it is still doing good as compared to Britannia, but you would have been able to generate better returns with Hindustan Unilever. You can see there is almost a similar pattern followed in their charts as well. Now, if we want to look at the price point, as I've told you, it is trading nearly at their 20,350 52-week high, and low from their 52-week high is at 0%. So there is a huge chance that they might break out from their 52-week high. Now, if we want to look at the analyst rating, analyst has given it a buy rating. So at the lowest low, it can give you a negative of 6 to 8% return, falling back to 15,000 range. And if it performs well, it can give you a median price range of 21,000 at the year end. After year end, that means October 23, forecast says the price should move up to this point. And if it able to perform like exceptionally better, then its price can touch starting point of 24,000. Currently the trading price is at nearly 20,350 rupees. Now, if we want to check the fundamentals checklist, we want to see a snapshot of it. We can see intrinsic value is more is not looking good. Current price is more than the intrinsic value. ROE versus FD return, ROE was at 104, I believe, and FD generally range from 6 to 8%. So it is able to beat our FD by a huge margin. Dividend return, stock offer good returns. It has given a 120 rupees dividend, and I believe the record date is 31st October. So if you buy it before 31st October, you will be able to get 120 rupees as dividend on an investment of 20,000. So this doesn't surely look good from that perspective. Entry point, not a good time to invest. Stock is in overbought zone. It is nearly at 52-week high, so it is not a good point, we can see. And no red flag, stock is not in ASM GSM list, so no promoter holding is pledged. That is a good huge plus. Default probability very low probability of default in next 12 months, we can see. And quality check, among the top performer in quality check growth score, we have seen its growth rate is like doing up and down, so there is a satisfactory performance in growth score expected. And that's all for Nestle. And please like, share and subscribe to this video, and I'll come back with results of next company soon.